Capital allocation decisions extend beyond investment choices. How firms return cash to shareholders through dividends, share repurchases, or retention represents one of the most strategically significant and debated topics in corporate finance. This module explores the theoretical foundations, practical applications, and real-world complexities of payout policy. Payout policy is where finance meets psychology. It's not just about what's optimal on paper, it's about what investors expect, what managers fear, and how markets interpret every move. In this module, we'll explore how theory meets practice through AutoZone's remarkable capital return story. This module isn't just about dividends or buybacks, it's about the art of strategic capital stewardship. You'll make executive level recommendations that balance growth, investor trust, and long-term performance. Our learning objectives in this module include evaluating alternative payout policies, assessing multidimensional considerations, integrating strategy with business context, and recommending value-creating policies. Let's take a quick step back and talk about why firms actually pay out cash to shareholders, or why sometimes they don't. This is one of those moments where finance theory meets messy real-world behavior. On paper, payout policy shouldn't really matter, but in practice, it matters a lot. So, dividend irrelevance, the classic view. Back in 1961, economists Modigliani and Miller gave us what is known as the dividend irrelevance theory. In a perfect world, no taxes, no transaction costs, no information gaps. They argued that a company's decision to pay dividends wouldn't affect its overall value. Investors could simply sell shares if they wanted cash or buy more if they didn't. In other words, payout policy was, well, irrelevant. But of course, we don't live in that world. In reality, markets have frictions, taxes, trading costs, and lots of information asymmetry. That means payout choices do in fact affect customer behavior. They change how people perceive stability, trust, and management confidence. So while the theory says value doesn't change, in practice, perception does, and perception drives stock prices. Next comes signaling theory, one of my favorites because it blends finance with psychology. Signaling theory says that payouts, like dividends or share buybacks, send a message. They tell the market we're confident about the future. When a company raises its dividend or announces a repurchase, investors interpret it as a management saying, our cash flows are strong, we're not worried. But when dividends are cut, that's a completely different story. Cutting a dividend is like pulling the fire alarm. It tells investors something's wrong. Maybe cash flow is tight or profits are under pressure. Stock prices drop sharply because of what the cut signals, not necessarily because of the dollar involved. So for managers, payout decisions become powerful communication tools, a way to manage market expectations and signal confidence. Now in this third role, we're talking about agency theory. The idea that managers don't always act in the best interest of shareholders. When firms have big piles of cash and few growth opportunities, management may be tempted to spend that cash on low return projects, or worse, empire building. Think of it like giving a teenager an unlimited credit card. You hope they'll spend wisely, but a little discipline doesn't hurt. Agency theory argues that returning excess cash through dividends or buybacks helps keep management accountable. It limits the temptation to overinvest and forces discipline by making management justify the new financing through capital markets. This is especially relevant in mature, cash-rich firms like AutoZone, Apple, or Microsoft, where growth is steady but not explosive. Returning cash prevents waste and rewards shareholders directly. So, to sum it up, classic theory told us payout policy doesn't matter, but modern reality tells us it absolutely does. Why? Because it affects signals, discipline, and trust. For financial managers, the decision about dividends and repurchases isn't just arithmetic. It's about communication, confidence, and stewardship. When done right, payout policy becomes a bridge between financial performance and investor perception. The math meets the message. 94% of firms avoid cutting dividends at all costs. Repurchases now dominate, preferred for flexibility and market timing. Taxes are a secondary consideration. Firms use buybacks to offset stock option dilution or adjust capital structure. Executives told researchers dividends are sacred, buybacks are tactical. Dividends say, we've arrived, and buybacks say, we're optimizing. Both send different messages to investors, but both require discipline. I want to talk briefly about our case study for this week. AutoZone pays no regular dividend. They focus entirely on repurchases. They've repurchased over $20 billion in stock since the early 2000s. Their EPS grew dramatically even as net income remained stable. Aggressive leverage used to fund repurchases, high debt-to-equity ratio. The objective? Maximize shareholder value while maintaining control of capital allocation. AutoZone is a poster child for modern payout strategy. They've turned buybacks into a value machine, shrinking share count, juicing the EPS, and rewarding long-term holders. But as you'll see, this strategy isn't risk-free. It depends on sustainable cash flow and disciplined debt management. These metrics form the backbone of payout analysis. AutoZone's dividend payout ratio is 0, but its total payout ratio is one of the highest in the S&P 500. That tells us the form of payout may differ, but the commitment to shareholder return is the same. This is a good slide to refer back to when you're preparing your written case analysis for AutoZone. Now, in your assignments this week, you explore 3 policy alternatives using the alternatives that you see here. Dividend focused, that's higher dividends, fewer repurchases. Repurchase focused, eliminate dividend and continue buybacks. And then balance policy, moderate dividends and steady buybacks. Each approach has trade-offs. A dividend policy improves investor trust but limits flexibility. Repurchases maximize EPS control but risk over-leveraging. We will analyze AutoZone's results under each scenario in Module 5 using the Excel tool. The Excel analysis mimics the decision logic of real CFOs. Stress testing ensures that payout commitments survive under volatility because nothing undermines market confidence faster than a dividend cut or a canceled buyback. You see here on this slide some key analysis components. Again, this can be very helpful as you work through your case analysis for AutoZone this week. Those key components are payout ratio trends, FCF coverage analysis, EPS accreditation dilution, breakpoint identification, and sensitivity testing. Feel free to refer back to this slide as you work through this case study. Now that we've covered why firms return cash to shareholders, let's look at how they do it. Specifically, the two main approaches are dividends and share repurchases. Both achieve the same financial goal, returning capital, but they send very different messages to the market and attract very different types of investors. Think of it like two different love languages. Dividends say, "I'll always be there for you," while buybacks say, "I'm flexible and I know a good deal when I see one." Dividends are that traditional, steady method of sharing profits. When a company pays regular dividends, it sends a clear message to investors. We're confident our cash flows are predictable and sustainable. Investors love that reality. It creates trust and attracts a loyal, income-oriented investor base, retirees, pension funds, and those who like a steady paycheck from their portfolio. But here's the catch. Once you start, you can't stop. Dividends are what we call sticky. Investors come to expect them. And if you ever cut your dividend, the market reaction is usually brutal. Stock prices can drop 10 to 15% almost overnight. That's because a cut signals trouble, not thriftiness. And there's another key point. Dividends are equal for all shareholders. Whether you need the cash or not, you get it. You can't selectively target investors. Finally, dividends require cash certainty. Management must be confident that even in tough years, recessions, supply chain disruptions, or pandemics, the company can keep paying. So, dividends are about stability and reputation. They say, "We're here for the long haul." Now, the other option, repurchases or buybacks, they've become the dominant payout method in the 21st century because they offer flexibility and strategic control. When a company repurchases its own shares, it's telling the market, "We believe our stock is undervalued." That's a strong signal of management confidence, but without long-term commitment of recurring dividend. Repurchases are discretionary. Managers can ramp them up when cash is strong or pause them during a downturn. That makes them ideal for firms with cyclical earnings, like auto parts retailers or industrial companies. Buybacks also tend to appeal to tax-efficient investors, like institutions or high net worth individuals, who prefer capital gains over dividend income, since gains can often be deferred or taxed at lower rates. And here's another difference. Buybacks are self-selecting. Only shareholders who choose to sell their shares participate, while others automatically see their ownership percentage increase. It's like rewarding long-term holder with a bigger slice of the pie. Finally, repurchases are rewarded for smart timing. If a company buys its stock back when it's undervalued, it can create tremendous shareholder value, like AutoZone did, reducing its share count by over 80% since the early 2000s. So, what's the trade-off? Dividends communicate commitment, a stable relationship with investors. Repurchases communicate confidence, management's belief in their own stock, and flexibility in changing conditions. Neither is inherently better. The right choice depends on companies' cash flows, stability, investor base, and strategic goals. For example, a mature utility company with stable earnings should favor dividends. But a company like AutoZone with fluctuating cash flows, steady profits, and undervalued stock, they gain more by buying back shares. In the end, payout policy is part math and part message. Dividends say we've made it, buybacks say we're still building. Both require wisdom because returning cash is not just about numbers, it's about stewardship, timing, and trust between a company and its shareholders. Payout policy transcends pure financial engineering. It reflects fundamental questions about corporate purpose, managing stewardship, and the balance between short-term optimization and long-term value creation. These considerations are particularly relevant as scrutiny of a corporate behavior intensifies. The stewardship principle states capital should serve long-term value, not short-term optics. Over-repurchasing can signal financial engineering, not real performance. A faith-based lens, financial decisions as stewardship, not speculation. And the key question becomes, are we creating genuine shareholder wealth, or are we just inflating the metrics? As Christian business leaders, our stewardship lens reminds us the goal isn't just shareholder return, it's sustainable, ethical value creation. Repurchases are powerful tools, but without prudence, they become mirrors of pride. Dividends signal commitment. Repurchases signal confidence. Flexibility matters more than form in modern payout policy. Always test sustainability under stress. Align payout strategy with long-term business model and stewardship principles. AutoZone's case shows that payout policy is strategy in disguise. When done well, it builds trust, resilience, and shareholder value. When done poorly, it erodes credibility faster than any missed forecast.